Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
Traders, I got your watch list for Friday, June 23rd road. Let's recap today's trading session first. The equities market closed mixed, with the S&P 500 and Nasdaq recording gains while the Dow Jones and Canadian TSX ended in the red. The mixed performance came as Federal Reserve Chair Jerome Powell emphasized the central bank's commitment to combating inflation during his testimony to Congress. Powell's comments suggested that 2 more rate hikes are likely in 2023, signaling an ongoing rate hiking cycle. However, it is believed that the Fed is nearing the end of its campaign, with only 1 or 2 hikes remaining, and will closely monitor inflation and economic data. Treasury yields also increased, with the 2-year Treasury yield rising to approximately 4.79%, indicating a significant climb from its recent lows in mid-May. The yield curve, which measures the difference between the 10-year and 2-year Treasury yields, remained highly inverted at around -1.0%, historically indicating a potential economic downturn or recession on the horizon. Meanwhile, the labor market showed some signs of easing as U.S. weekly jobless claims figures continued to rise. Jobless claims reached 264,000, surpassing expectations of 259,000. This marked the 3rd consecutive week of claims above 260,000, reaching the highest levels of the year and significantly exceeding last year's average jobless claims level of 213,000. While the current figures remain relatively healthy compared to historical data, the upward trend could be a leading indicator of a softening labor market. Total job openings in the U.S. have also declined from their recent highs and are now close to 10 million, down from the peak in March of over 12 million. It is expected that the labor market will cool down in the coming months, although unemployment is likely to rise more modestly compared to previous downturns, remaining below 5.0% in line with the Fed's forecast of a peak unemployment rate of 4.5% during this cycle. In a surprising move, the Bank of England, BoE, raised interest rates by 0.5%, bringing its benchmark rate to 5.0%, the highest level in 15 years. The decision was driven by persistently elevated inflation readings in the UK, with headline CPI inflation for May reaching 8.7% and core CPI at 7.1% year-over-year. These rates significantly surpass the inflation rates in the US, which stood at 4.0% and 5.3% respectively. The markets across Europe reacted negatively to the news, as higher inflation rates and slowing economic growth continued to pose challenges. The slowdown in Europe could be further compounded by the slower-than-expected reopening of the Chinese economy. As Europe has stronger trade ties with China compared to the US, it is more exposed to the impact of reduced demand from the region. Turning to the watch list, 3M, a multinational conglomerate, reached a tentative $10.3 billion settlement with numerous U.S. public water systems to resolve water pollution claims associated with Forever Chemicals. The settlement, which spans a 13-year period, will provide funds for testing and treating contamination of per- and polyfluoroalkyl substances, PFAS, in cities, towns, and public water systems. Although 3M did not admit liability, the settlement aims to support remediation efforts in detecting any level of PFAS in drinking water. This settlement marks the largest in American history for drinking water and will contribute to the health and well-being of millions of Americans by providing cleaner drinking water. However, 3M still faces PFAS-related lawsuits from individuals in U.S. states over personal injury, property damage claims, and damages to natural resources. In the technology sector, C3.ai, a leading AI company, hosted its Investor Day on Thursday in New York. During the event, the company provided updates on its product roadmaps and demonstrated new generative AI features. Investors were particularly interested in any information regarding the company's transition to a consumption-based pricing model and its impact on revenue growth. C3.ai's stock had experienced a 4% decline on Tuesday. In its fiscal fourth quarter report, released on May 31, C3.ai reported sales of $72.4 million, which aligned with the higher end of its preliminary sales figures. The company's sales growth remained flat compared to the previous year. Subscription revenue accounted for 79% of the sales, amounting to $56.9 million. C3.ai reported a loss of 13 cents per share, an improvement from the 21-cent loss in the same period last year. The company generated $16.3 million in free cash flow from business operations during the quarter. After breaking out of a consolidation phase in March, C3.ai ICE stock pulled back and fell below the 50-day moving average in April. However, it experienced a 33% surge prior to the earnings report. Subsequently, the stock formed a cup base and currently remains extended from the 34.68 buy point, having reached its 20% profit target from that entry. C3. ICE stock received a boost when Oracle, ORCL, reported a surge in fiscal fourth quarter sales, driven by demand for cloud computing to meet generative AI demands. Oracle's investment in generative AI startup Cohere positioned it as a competitor to companies like Amazon.com, AMZN. The continued growth in AI workloads was expected to drive demand for cloud infrastructure. For the entire fiscal year ending April 30th, C3.ai recorded sales of $266.8 million, surpassing earlier estimates of $264 million to $266 million. The company aims to achieve sustainable profitability by the end of fiscal 2024, with analysts forecasting 19% sales growth for the year. In December, C3.ai transitioned its pricing model from subscription-based to consumption-based. This move aligned the company with industry standards for software as a service providers, which is a common practice among major players like Amazon, Com's AWS, Google Cloud, and Microsoft Azure. The shift to consumption-based pricing is expected to drive revenue growth, although the impact may not be immediate. By providing customers with unlimited use and developer licenses, the new pricing model lowers entry barriers and allows companies to avoid long contracts. C3.ai, based in Redwood City, California, offers AI-enabled software applications that can be customized for various purposes, such as improving network reliability, detecting fraud, optimizing supply chains, and enhancing energy efficiency. The software also aids in combating money laundering. Moving on to another company, Teladoc is a healthcare disruptor that provides telehealth services, enabling individuals to access medical care conveniently and remotely. This eliminates the need for lengthy clinic waits, expensive fees, and scheduling difficulties. Teladoc's value proposition proved especially beneficial during the COVID-19 pandemic, leading to a significant increase in the company's stock. However, Teladoc has experienced decelerating growth over the past few years and has yet to turn a profit. Nonetheless, the company exceeded expectations in its most recent quarterly report for the first quarter of 2023. Revenue increased by 11.3% year-over-year, reaching $629.24 million, which surpassed analysts' estimates by $11 million. Although Teladoc regularly operates at a loss, it reported an earnings per share, EPS, of -42 cents, surpassing expectations by 8 cents. The company provided a strong revenue guidance for the second quarter of 2023, projecting revenue in the range of $660 million to $680 million. This outlook exceeded analysts' expectations and indicated positive momentum for Teladoc. Teladoc's growth can be attributed to several factors, including increased adoption of telehealth services, expanding partnerships, and strategic acquisitions. The COVID-19 pandemic played a significant role in accelerating the adoption of telehealth, as individuals sought safe and convenient alternatives to in-person medical visits. Teladoc capitalized on this trend and experienced a surge in demand for its services. Teladoc's partnerships with various healthcare organizations and insurers have further contributed to its growth. Collaborations with large healthcare providers, such as CVS Health and Humana, have expanded Teladoc's reach and increased its user base. These partnerships have also helped integrate telehealth services into existing healthcare systems, making it more accessible to a wider population. In addition to partnerships, Teladoc has pursued strategic acquisitions to strengthen its position in the telehealth market. One notable acquisition was its merger with Livongo, a leading provider of remote monitoring and chronic disease management solutions. This merger expanded Teladoc's capabilities and allowed the company to offer a more comprehensive suite of services to its customers. Despite its growth and increasing revenue, Teladoc continues to face challenges in achieving profitability. The company's expenses, including marketing and technology investments, have outpaced its revenue growth, leading to ongoing losses. However, Teladoc remains optimistic about its long-term prospects and expects to achieve profitability as it continues to scale its operations. Looking ahead, Teladoc aims to capitalize on the growing demand for telehealth services by expanding its international presence and investing in innovative technologies. The company sees significant opportunities in markets outside the United States, where telehealth adoption is still in its early stages. By leveraging its expertise and experience, Teladoc plans to capture a larger share of the global telehealth market. In conclusion, Teladoc has demonstrated strong growth in the telehealth sector, driven by increased adoption, strategic partnerships, and acquisitions. Despite ongoing losses, the company's recent financial results and positive revenue guidance indicate promising prospects for the future. Teladoc's ability to navigate the evolving healthcare landscape and capitalize on emerging opportunities positions it as a key player in the telehealth industry. Thanks for watching. We hope you found this video informative and engaging. Don't forget to subscribe to our channel for more updates on the latest financial news and investment strategies. Remember to hit the like button and leave a comment below, letting us know what stocks you're currently watching. Your engagement is crucial in helping us create valuable content like this. Stay tuned for more insightful videos, and once again, thank you for being a part of our finance community. Happy trading!